All right. This is Sherpa going live on LinkedIn, YouTube, and everywhere else that you can get to via social media, I think. I don't know. Who knows whether we're actually streaming to all of the available channels or not. But we at OZ Pros, we're big fans of going through and talking about opportunity zones. It's what we focus on. But we're also we're really into, and we want to make sure that we hit and that we talk about all potential tax ramifications. And one of the things that that is substantial is just kind of keeping an ear to the ground relative to some other things that are happening inside of the tax world. And one of those things, and it happens every year, is that the administration puts out a thing called the Greenbook. And the Greenbook is basically as part of it's part of the administration basically saying, okay, this is what we're going to do, right? Or this is what our plan is relative to how we're going to approach taxation and what ramification that's going to have on the aggregate budget. And this is actually released by the Biden administration. And this is what it says that it actually is. The Green Book outlines critical tax proposals that will support President Biden's investments in the American people by ensuring the wealthy and large corporations pay their fair share, lowering costs for hardworking families, and further reducing the deficit. And the U.S. Department of the Treasury released the Green Book on March 9th. And it's interesting that more people haven't been talking about this because some fairly significant things that are going on inside of the Green Book. And it's great because you can kind of pick up and I can kind of highlight those. And I'll summarize these here in the, like as we kind of go through, I'll summarize them at the end of our live stream. But this is it. This is the Green Book. Ooh, doesn't look very green to me. What do you guys think? It looks pretty white. So let's scroll down. Let's just go down to the table of contents, if I can find the table of contents. All right, revenue proposals. First and foremost, the Biden administration is going to reform business taxation. Yeah, we knew that was going to happen. President Trump gave us 21% corporate tax rate, and the Biden administration's not real keen on that. As promised, I don't know why I can't get my my scroll bar to cooperate here, but this is the table of contents. So not surprisingly, they're going to raise it to corporate tax to 28%. They want a corporate alternative minimum tax. Wow, they're only going to leave that at 21%. And then they're going to close loopholes. And, and so you can kind of see some of the specifics that are here inside of that. Not surprisingly, they're also going to reform international taxation. And here's the thing is that on some of this stuff, and as we get into the stuff, that's into the individual stuff, there's actually one that relates to opportunity zones that I actually think is good. And I'm going to let you guys form your own opinion about the rest of this stuff. Hey, they're going to support housing and urban development. That's awesome. That's fantastic. Make permanent the new market tax credit. I wish that they'd go ahead and put in there, make permanent the opportunity zone legislation. But they're going to modify energy taxes. They're going to, they want to increase the taxes on fossil fuels. Look at this one. Impose digital asset mining energy excise tax. So that's on page 72. And I want to go through this full table of contents, and then we'll jump around and we'll kind of come back to some of these. Strengthen taxation of high-income taxpayers. Apply the net investment income tax to pass through business income of high-income taxpayers. So the net investment income tax is effectively the Obama tax, right? That's that 2.3%, 3.8% that they imposed. And so they're trying to get that on, on certain stuff that's been exempt before. Increase the net and additional Medicare for tax rate for high income. Increase the top marginal income tax. Reform the taxation of capital income. This is a big one. Pay attention, boys and girls, because they're trying to make the capital gains rates basically be taxed as ordinary income based upon how much money you make. Modify rules relating to retirement plans. All right, so they want to get rid of that Roth IRA loophole where you can accumulate a gazillion dollars in a Roth IRA that's tax free. This is actually pretty good. They want to expand the child tax credit. And, I don't know. I guess, it kind of depends on where you sit on the spectrum of that stuff. But this is a big one for the Democrats and is kind of keystone to the current tax legislation that's bouncing around right now. We'll see what ends up shaking out with that. Modify estate and gift taxation. Close loopholes. Look at this one. Tax carried profits interest as ordinary income. If you're a developer, pay attention to that one. It's on page 137. Repeal deferral of gain from like-kind exchanges. See you, 1031. Your deferral is going away. Require 100% recapture depreciation deductions as ordinary income for certain depreciable real property. Man, if that depreciation recapture wasn't bad enough, we're going to make it worse. Modify depreciation rules for purchases of general aviation passenger aircraft. Limit use of donor advised funds to avoid a private foundation payout requirement. I actually want to check that one out. It's funny because if this thing doesn't ultimately go through, this is kind of a roadmap to loopholes, right? You need to check that one out. How can you use a donor advised fund and creatively use that one? Extend the period for assessment of tax for certain qualified opportunity fund investors. This is on page 147. And what's funny is that, and I'm actually going to go to this one because this is the one that that ends up, kind of affecting most of my clients and followers. So we're going to go straight to that. Deferral of gain from like-kind exchanges. Apparently the actual page numbering is not what it is on here because you got a couple of pages on the front. So, okay, so tax carried interest. We're looking for page 147 here. But this is really important for folks to take a look at because this is basically the roadmap of what the Biden administration wants to do relative to kind of the taxation piece. All right, and this one actually, you know what? It's not the best, but at the end of the day, I can kind of understand where they're coming from. Basically, what they're saying is that that current law says that the IRS has to assess the tax within 3 years after the filing of a tax return. And then it says that, if you invest into a qualified opportunity fund, you get to defer that tax until December 31st, 2026, or an earlier date on which there occurs any of various inclusion events. And so inclusion events may require some taxpayers to recognize the deferred gain before that date. In many events, the only manifestation of the inclusion event on the taxpayer's return is the inclusion of the deferred gain in gross income. Thus, inclusion events that occur prior to December 31st may not be readily identifiable on the taxpayer's return, which is interesting because you actually have to show that there's been an inclusion event, right? So when you file it, you have to show it. Now, I guess in their defense, they're saying, hey, listen, it may not show up. And if the taxpayer doesn't know that an inclusion event happened, and they don't report it correctly, then we're not going to know. So I guess that's an interesting piece to this. But the proposal would provide that if an inclusion event requires deferred gain to be included in gross income, but the taxpayer fails to properly include that deferred gain, or the taxpayer in any other way fails to properly reflect on one or more of the tax returns. So I guess that's what they're saying. Hey, listen, they didn't correctly do this on the 8997, which is where you would report an inclusion event, and on Form 8996 is where you also are obligated to report an inclusion event, that the time during which these deficiencies may be assessed would not expire before the date that is 3 years after the date on which the IRS is furnished with all the information that it needs to assess these deficiencies. So, you know what? In this case, I kind of get it. It's like, hey, if you are saying to the IRS, hey, I put this money into a fund and I'm going to defer it, then arguably, I actually think that you are probably extending out the time period on which they can go back and they can reopen your tax return. I mean, arguably, I think that you could be extending that out until the full 10 years when you ultimately take the step up in basis to fair market value. Then you've got basically 3 years from that date in order to to where the IRS could kind of come back. But it basically puts the last 10 years of records where they can examine them. Now the question then becomes is if for whatever reason you had an inclusion event prior to December 31st, 2026 and you failed to adequately pay the taxes, right? What happens to that 10 years out? Can they go back and go back to that one? I don't know the answer. Probably not, because this is what they're trying to do inside of this. I think the government is, saying, well, no, we're not going to be able to do that. That's why we need to get this rule changed. And so it'll be interesting to see if this ultimately gets legs and it gets traction. But once again, the Green Book is very important for folks to be paying attention to, because it's a roadmap of what the government is thinking relative to what they want to do with taxes. And as you can see, they are really trying to close loopholes and close the things that high income earners and high, capital gains earners, they specifically say it, that, inside of the document, at the front end of it, they say that, hey, capital gains income is, that it's shifted in favor of, high income earners, and it shouldn't be. And so they're going to try and make that, they're going to try and close that down and shift it. Let's see if I can come up with because I think I might be able to actually, I think that, yeah, you can actually see this. All right, it's going to raise additional revenues. Pass-through owners would sharply curtail tax preferences that allow the wealthy to pay lower tax rates on their invested income and exacerbate income and wealth disparities, including by gender, geography, race, and ethnicity. All right, they actually said something else in there. Ooh, yeah. For an employee would incorporate for over $1 million and close several business tax loopholes. All right. A new 25% minimum income tax would be imposed on extremely wealthy taxpayers. And I actually think so. There's actually a provision in here. This is actually kind of an interesting one. Let's see if we can find this one. Where I think that they're trying to tax unrecognized capital gains for folks that are over $100 million in net worth. Insurance products limit tax benefits for PPLI. So noteworthy on that they're trying to also really kind of close that private placement life insurance piece as well. Ultimate purchaser, deduction or transfer of property, reform access. So I don't know that I can find it, but we're going to look and we're going to try to address taxpayer noncompliance. Extend to 6 years the statute of limitations for certain tax assessments. Wow. All right. Define controlment, modernize rules, including those for digital assets. Wow. Apply the wash sale rules to digital assets and address related party transactions. Wow. They're trying to put the wash sale in there as it relates to crypto. Modernize rules treating loans of securities as tax-free to include other asset classes and address income inclusion. Foreign digital asset accounts. Amend the mark-to-market rules to include digital assets. Wow. Where you actually have to recognize that. All right. Where is the... I can't find the one where it says that if you're over $100 million that you got to recognize capital gains. But I definitely think that was inside of that. All right. So then it goes into raise the corporate income tax. All right. So then it just jumps into the stuff that we've already kind of talked about, which actually, while we're looking at this, let's go back up to that one about crypto. Let's see what they're talking about inside of the crypto space and that excise tax on crypto. So we're going to go back to this. Impose digital asset mining energy excise tax. That's on page 72. So we're going to go to 72 right here. Bam. All right. All right. Modify energy taxes. We've got all of the expensing of mine exploration and development costs. This is actually an interesting one as well. Reasons for change proposal. All right, they're trying to get rid of the oil spill deal. Impose digital asset mining energy tax. Digital asset mining is a process. The computational effort involved can be substantial and can therefore require a correspondingly large amount of energy. Has negative environmental effects and can have environmental justice implications, as well as increased energy prices for those that share an electricity grid with digital asset miners. Also creates uncertainty and risk to local utilities. Is mining activities highly variable and highly mobile. All right. Any firm using computing resources, whether owned by the firm or released from others to mine digital assets, will be subject to an excise tax equal to 30% of the cost of electricity used in digital asset mining. Ouch. So an automatic 30% bump, which is interesting. Well, and I guess they're trying to curtail it. They're trying to basically make it so that crypto mining is less attractive. Would be required to report the value of the electricity used, which would serve as the tax base. Firms that produce or acquire power off grid, for example, by using the output of a particular electricity generating plant, would be subject to an excise tax equal to 30% of estimated electricity costs. What is that? So they're saying that if you produce or acquire power off grid, what is that? So if I put a solar field out there, and I'm using that to digitally mine, that I've got to pay 30% of what my electricity cost, what I think they would be. Are you freaking kidding me? Holy crap. The proposal will be effective for taxable years beginning after December 31st, 2022. Oh, well, thanks. Thanks for giving us till the end of the year. Holy cow. 10% the first year, 20% in the second, and 30% thereafter. Now, so this is the interesting piece about what the Greenbook is that, man, I think that this is just a wish list. And I'm hoping that it's just a wish list and that our legislators out there that, are out there, they're actually going to make the laws, that they're going to really look at this and they're going to be like, wow, that's probably not such a great idea. All right, let's go and look at this. Reason for change. Active owners of pass-through businesses are treated differently for purposes of the NIT, SICA, and FICA. They're basically trying to close that S corp, pay SICA taxes. S corporation owner employees pay employment taxes on only a portion of their earnings, and limited partners often pay little or no SICA tax. Although the NIT reflects an intention to oppose the 3.8% tax on both earned income of high income. So S corporation shareholders and distributions to limited partners escape the combined 3.8% from FICA or SICA and the NIT. So it's effectively a 4% bump. These inconsistencies in the treatment of pass-through business are unfair and efficient. Yeah, well, that's why that's why the smart money uses an S corp. It's because you save 3.8%. Determination of reasonable compensation of S corp owner employees generally depends on facts and circumstances and requires a valuation analysis. Can be contested by the taxpayer. Dang right, because that's fair. It increases IRS costs of administration and enforcement. So proposal would expand the NIT base to ensure that all pass-through business income. Well, if this goes through, it'd make it a lot easier. You just go with an LLC and then not have to fool with actually, getting that payroll company on board and paying yourself a salary. Okay, so the specified percentage would start at 0 and increase linearly to 100 as adjusted gross income rises from 400,000 to 500,000. The threshold amounts given in the paragraph would not be indexed for inflation. Material participations would apply to individuals who participate in a business. Taxpayers usually considered immaterial when they're involved in a regular continuous and often this means they work for the business at least 500 hours per year. The statutory exception to SICA for limited partners would not exempt the limited partner from the NIT if the limited partner otherwise materially participated. Okay, well, I get that one. And so they're also talking about increasing the net investment income tax rate, an additional Medicare tax rate for high income taxpayers. All right, so we're going through this one. Anyhow, I don't want to bog it down. I don't want to really, get wrapped around the axle because not sure about whether or not this is actually going to go through. So we just got to kind of check it out. Yeah, I see we got some comments here. Hi, Ashley. Is there any new tax savings opportunities in Biden's benefit to benefit low-income communities? Actually, there was in there. It does, right? So under the HUD section, and I can go back and go back up there to that piece, is that we're going to go back to this one. Is that there's support housing and urban development, make permanent the new markets tax credit. So that's actually designed. It's funny is that you actually can't have a pure residential project. You actually have to have some commercial in order to take advantage of the new market tax credits. But it does say that they're looking to provide a neighborhood homes credit, 58, and then expand an income and enhance the low-income housing credits. So yes, I think that on page 58 and maybe on 62, wow, I've got Jimmy Atkinson in the house. He's attending live. Appreciate you being here, Jimmy. Yeah, I do think that this is a pie in the sky wish list, but it's a wish list that everybody needs to be paying attention to because this is literally, I mean, it'd be one thing if this was like hyperbole of like, hey, I'm going to do this, right? I'm going to raise taxes on the rich that everybody always kind of hears when they're out there, stumping. But this is actually like put out there by the administration. And so people should be paying attention to this because it's like, oh, wow, right? This is real. All right. So we're going to go down to, 58. We're going to see if there are actually some sections in here that might be beneficial to the man. And the part of the problem is that you got to actually go through the provide a neighborhood homes credit. The proposal will create a new allocated tax credit, the neighborhood homes credit, to encourage new construction for sale, substantial rehabilitation for sale, and substantial rehabilitation by existing homeowners will remain in their communities. The credit would be allocated through each state's neighborhood homes credit agency, and each state would create or designate an NHCA. All right, well, there we go. We got another bureaucracy that's going to get formed, kind of like a CDFI, to allocate potential NHCs to project sponsors, i.e. individuals or entities that organize the project, would apply to their state NCA, would evaluate the applications, and then would monitor the compliance. And they would set standards for developer fees, building quality, yada, yada. And so they would have a $8 million of the product is 6 times the state's population. And it could be, the projects have to be a single family home. Project must be in an NHC neighborhood. Let's look what that is. Is a census tract that meets one of the least of following criteria. Median family income not exceeding 80%, poverty rate, median value. So I don't understand why they didn't just say opportunity zone. They did say located in a disaster area. But why not? Why not say, oh, if it's in an opportunity zone, it qualifies? Because then they'd actually have to acknowledge that, man, opportunity zones are actually a pretty good way of classifying this. An NHC qualified owner is someone who will use the home as their primary residence, whose household income does not exceed 140%, and who in the case of sale is not related to the seller. You know what? I actually kind of like this one. I haven't dove into it completely, but off the cuff, it actually seems pretty good. So there you go, Taylor. Is that we've got a tax savings opportunity for potentially doing deals in HC if this ultimately gets legs and goes through, which might be something that they ultimately pass through. We Jimmy, we actually had a really good Opportunity Zones working group call today, and we talked about some state initiatives that are actually happening right now. And we talked about that. Not surprisingly, New York's still trying to get their legislation through to decouple from Opportunity Zone legislation. But Illinois actually introduced legislation to that there would be a tax credit, an Illinois state tax credit that would be fully transferable in the year for dollar tax credit for every equity infusion that went into a qualified opportunity fund, which I maybe is one of, it's part of the reason that they put this through is because Illinois has gotten the least amount in all 50 states, or maybe it's one of the least. I don't know if it's the least or one of the least, but it's definitely down there of allocated opportunity fund investment during the whole time that that Opportunity Zones have been in effect. And so that would be really powerful if that goes through. Can you imagine that? You do a deal in Illinois, hey, and you can completely, with your investment, you can completely offset all your Illinois taxes. Bam. Needless to say, I think that they would get some significant influx of cash into qualified opportunity funds that are doing projects in Illinois. So kudos to Illinois for introducing the legislation. Once again, I think that it probably is similar to a lot of the other legislation that's out there right now, which may not have a whole lot of chance of getting passed, but sure would be cool if it did. All right. Well, we're going to wrap this one. We're going to call it a day, and appreciate everybody participating. Appreciate you guys being part of the OZ family, and we'll catch you next time. This is Sherpa out.